Let's go ahead and introduce our panelists for today's conversation. First, we have John Gross as Vice President of Corporate Banking. John Gross is responsible for the bank's corporate banking team at FNBO, serving corporate clients spanning the bank's footprint. John's career began with First National Bank as mergers and acquisitions analyst. In addition to buy and sell side advisory services, he has experience with short and intermediate term investing. John earned a Bachelor of Science degree in Business Administration from the University of Nebraska-Lincoln and a Master's of Business Administration from Creighton University. Next, we have Craig Jones. Craig joined First National Capital Markets in August of 2012 as Managing Director of Public Finance. Craig obtained his bachelor's degree from the University of Nebraska-Lincoln and his law degree from Creighton University School of Law. Craig's practice focuses on taxable and tax-exempt debt issuers in the private and public sector. And then lastly, we have Ramon Rodriguez from our partner derivative path. Ramon is a sales and structuring specialist where he helps his regional and community banks and their borrowers manage interest rate risk. Ramon's previous professional experience spans financial markets and technology. He spent over a decade working in derivative sales at a regional bank, at regional and global banks. And Ramon holds a bachelor's degree in business economics from Wheaton College and a master's in computer science from the University of Chicago. So gentlemen, thanks again for joining us today. Before we jump into our first topic on the transition of Libor, let's go ahead and open up with a polling question for our audience. So first polling question, do you currently have financial transactions that are tied to Libor? I think there's something like $200 trillion of contracts currently tied to Libor. So we'll see what today's sample size represents of that $200 trillion, I suppose. So let's see where those results come in at. So 63% of our audience today has contracts that are currently tied to Libor. 23% say they don't, and 9% say that they're not sure. So with that, let's kind of start with the basics. Ramon, what is Libor? Why is it used, and when is it actually going away?
Sure. So Libor stands for London Interbank Offer Rate. It is a short-term interest rate benchmark index. So it is intended to be a reference that can be used in financial contracts that are of a variable or floating rate. And it's intended to represent where a bank could borrow on a short-term unsecured basis. So the way it historically has been administered is a bank truly gets asked, a major bank gets asked, where could you borrow money from another bank today for 1 month, 3 months, whatever the terms might be? And it's really just their best guess. Unfortunately, because it was based on people submitting answers and wasn't transactionally based, there was some unfortunate manipulation tied to it. And so for reasons trying to tie it to transactions, it's being transitioned away. Today, it does use some transactional data. But in general, it is 16 different banks are polled. The highest 4, lowest 4 are thrown out, and then the remaining 8 are averaged together from those submissions. Libor, as you alluded to, is going away. So that polling is going to continue. Today it was actually formally announced that June of 2023 will be the last month that US dollar 1 month and 3 month Libor are published. So they're actually, Libor is actually published in other currencies. It's used in 5 other currencies. Those other currencies are actually going away sooner. I believe actually the end of this year, those other currencies are going away, but the US dollar Libor market is so large. I think the last statistic I'd seen was actually a few years ago, 350 trillion across various financial contracts, mortgages, bonds, loans. So it is an incredibly large market, and in particular US dollar Libor market. And so because of that, regulators are trying to allow ample time for an orderly transition. But June 2023 is the last date officially as of today that it will be considered a published rate.
Got it. So John, as we prepare for June of 23, what are some ways you've seen lenders across the market prepare for that transition?
Well, I would also expand on the timeline here for its sunsetting in November. There was a multi-agency bulletin that came out from the OCC, the Fed, and the FDIC that really put some real pressure on banks, and the terms that were used that any contracts written with Libor as the index rate after 12/31 of 21 would result in their mind in safety and soundness risk, or would add safety and soundness risk to banks. And those are sort of serious words coming from banking regulators. So when that announcement came out, we were already as a bank accelerating our transition off of prime where we could. And when that bulletin came out, I think it really sort of expedited those efforts. They also added in that bulletin that for contracts that are being written during this year, that it's imperative that it has robust fallback language. And so the Loan Syndications and Trading Association, which the bank is a member of, who provide form documents relative to large, broadly syndicated credits, they've now provided two options. One, an amendment option that basically says, hey, upon a triggering event, we will get back to the table effectively and decide what the an equivalent index and rate is, or spread is. The other is what you're going to start hearing more of, which is the hardwired option. And that's the, effectively, hey, SOFR is being put into the documents, and it's, sort of a very clear transition to SOFR upon that triggering event. So the bank, we're right now in the process of building out. We've got a committee building out our SOFR capability. I think I'll let Ramon get into some of the nuances and challenges relative to hedging and swapping out term SOFR contracts. But from a bank standpoint, most of our small and mid-market customers have been transitioned. I think the last number I saw was in and around 50%. And really the ones that haven't been transitioned, 30 to 40% mature this year. And the rest is probably there in some swap contract that is, a long-term legacy contract. But we're sort of going full steam ahead trying to get as many folks as possible converted to prime at this point.
Got it. Thanks for that. Thanks for that clarity. Ramon, what other sorts of financial instruments are tied to Libor, and what implications will the eventual sunsetting of it have?
So as I mentioned, it is used widely across financial markets. So it's used in loans from, small community business loans to very large corporate loans. It is used in bond issuances. It's often used as a fallback rate and used as a reference rate in mortgages. And then the derivatives market uses it as well. There's a robust derivatives market, interest rate derivatives market that uses it. So it is very broadly used. One of the difficulties in the transition, which John alluded to, is Libor had an inherent term structure. You could say, I want Libor for 1 month, or I want Libor for 3 months. And those rates were naturally different. And the 3-month rate was higher than the 1-month rate typically, which makes sense. Somebody has your money for longer. What's difficult in the transition is SOFR is a secured overnight funding rate. It's an overnight rate. And there is no existing term structure. And so you have these different instruments. You have loans, you have derivatives, you have syndicated loans, and there is some disagreement on how do you take an overnight rate and make it applicable for a term for 1 month or 3 months. Some say that rate should compound. Some say, no, you take the daily weighted average. And so what we've seen a lot of banks doing and a lot of customers requesting is choosing an indice other than SOFR, which I think FMBO is looking at is prime for a lot of these transactions because it avoids some of these dislocations. And it's a little more robust market, particularly in the lending and borrowing side. But it is a significant issue. As John mentioned, regulators want Libor gone as far as new contracts by the end of this year. They don't want new contracts put in place. They want plans to transition away. And it is very important to look into the finer print. If you are going to replace it and you have multiple contracts, they may not use the same type of fallback language. So taking time to make sure that those align and looking at the details is a critical part of it. And part of the difficulty, candidly, and why banks have been hesitant to do this, they've really needed to be prodded by regulators because it is such an overwhelming task to undertake.
Yeah.
Understood. John, going back to your comment about, the bank or FNBO switching borrowers over to prime when and where that makes sense, maybe speak a little bit about how prime and LIBOR have generally correlated over time.
Yeah, and I think that's, it's an interesting conversation too, to talk about what a secured overnight rate looks like relative to LIBOR. And, as all of our borrowers saw that borrowed off of LIBOR, when we had these market dislocations, say like in March of 20, LIBOR has, credit risk built into it, whereas SOFR does not, right? SOFR is a secured rate, overnight rate backed by repurchase agreements. So there is also this kind of dynamic where there's not really the credit risk. So from a borrower standpoint, that should result in maybe, a little bit more certainty about how SOFR will react, although we don't know because it's not been tested. But the dynamic between LIBOR and prime, the biggest thing that we sort of signal to our customers is that prime is generally, LIBOR is generally going to front run prime, right? So on the way down, LIBOR is going to anticipate the FOMC's rate reductions, right? So LIBOR will be a little bit lower, and then on the way up, same thing. LIBOR, as the FOMC raises rates, LIBOR will, front run those rate increases. And so, depending on the direction, one way or another, it's 5 to 7 basis points of sort of benefit on the way up, and reduction in or increase in borrowing costs on the way down. Does that answer your question, Matt?
Yeah, absolutely. And Craig, maybe moving over to the bond world a little bit, I think generally when we're talking about LIBOR, we naturally kind of associate that to credit structures, the shorter tenors. When we think about, the work that you do on the bond side, we're generally thinking longer tenors. What effect, if any, do you kind of see the sunsetting of LIBOR having on the bond market?
It'll be similar. But what I would say, Ramon and I were having this conversation earlier in the week. LIBOR has probably been used less and less in the bond market recently, given the rate environment. And I think issuers, as they strive to fix low cost capital for a longer period of time, the environment has been so favorable to municipal borrowers in terms of low rates that they've been looking for the fixed rate kind of long-term issue.
Got it. Well, let's go ahead and transition over to our second topic of the day and provide a bit of a market outlook or an update on where the market's at. And before we jump into that, let's do our second polling question. So the second polling question, do you think the Federal Reserve's actions to reduce rates and bolster liquidity in the markets has been effective? I think as we saw the economic effects of the pandemic take hold last March, we saw the Fed kind of resort to some of its old tricks that we saw in the financial crisis. Target rate dropped to 0. They started buying bonds again through quantitative easing. But then they also had some new tricks as well through things like their lending facilities, Main Street lending, for instance. And then I think they were even opening up their balance sheet to some muni debt and corporate debt as well. So, Craig, maybe I'll go to you. Any kind of thoughts on the effectiveness of the Fed's actions?
Yeah, I think it did have the desired effect in stimulating economic activity. The cost of capital has been so low that I think there's been a lot of opportunities and a lot of people taking opportunities to either get projects done or restructure existing debt, which would then maybe allow them to do something else within either their city or their business. I do think there's a market component to that, though. Just because the Fed necessarily cuts rates doesn't mean that equates to the market. I do think you're starting to see a little bit of a tipping point, especially in our world, where you have a borrower in terms of an issuer and a buyer in terms of somebody investing in those bonds. I feel like the buyers are starting to push back a little bit on the lower interest rate environment that the issuers have enjoyed for the past year and even longer, really, if you look back to the last financial crisis. So while the Fed maintains, that they're going to kind of facilitate easy conditions, that doesn't necessarily mean the market is going to allow that if buyers stop purchasing bonds, which will organically make interest rates have to rise to bring buyers back into the market.
Yeah, and I think it looks like the audience generally agrees. 74% coming in and saying that they think the Fed's actions have been effective. John, maybe I'll go to you. What are you seeing on kind of a micro basis? Is the customer base at FNBO generally reacting favorably to the stimulus dollars that have come in and the Fed's actions and taking advantage of these historically low costs of capital?
Yeah, I mean, and back to the 74%, I mean, the fact that the Fed's balance sheet's $4 trillion higher than it was a year ago, I sure hope it was effective, right? And I would say from First National's lens that, yeah, emphatically, yes. I mean, there are absolutely some pockets within our portfolio, hospitality and brick and mortar retail that are under stress and will be, and that we have to be patient with. But we've got such a diverse book with our consumer credit piece, our credit card portfolio, our ag and our business portfolios, that we get a pretty good and broad perspective on at least the economies in the markets that we serve. And by and large, our credit quality is really outstanding, to be honest with you, and it continues to trend in the right direction. Our treasurer said the other day that the consumer has been shockingly responsible with the stimulus dollars, and I thought that was spot on, right? And I think directionally these stats are right, that 35% of stimulus dollars went to deposits and 35% went to savings, and then 35% went to pay down debt. So 70% of the stimulus dollars it went in a way to sort of bolster the consumer's balance sheet. So yeah, I would say it's been really, really effective. PPP, another program that from our perspective, and I know there's criticism out there, but on a micro basis, we saw it not just injecting capital directly into our customers' balance sheets, but also just the sentiment and the confidence that it created during what was just unprecedented uncertainty. I had to go back and sort of put myself in March and April and May of 2020, and when you think about unemployment spiking to 23 million people, it was scary for everyone. And so that the PPP program and others really did put a bit of a floor in business and consumer confidence. So we see just across the board really strong consumers, generally really strong businesses right now, and we just saw an unemployment rate get printed today at 6.2%. So
yep.
Everything feels pretty good, maybe contrary to what most of the headlines and news articles would tell you.
Yeah, Ramon, can you maybe give the audience a little bit of context on just how low rates are compared to a historical basis?
Sure. From a short-term basis, obviously we've seen this before during the credit crisis with short-term borrowings coming down. On a long-term basis, you look at long-term rates. I think Craig alluded to this as well. It's a pretty unique time historically, and you look back over the last decade, candidly, and it's been a pretty unique time as far as being able to lock in long-term rates as low as they are. I think part of that, there's some pain. Recent stories, you can see the long end of the curve has gone up. Treasury yields are starting to rise. Long-term rates are rising the past couple weeks. It is painful when you look back over the last month or two. Historically, the nominal levels that we're looking at are still unbelievable. And you look back traditionally over the last 30, 40 years, and really how much would you care about the difference between going from, locking in a 3% to a 3.25% rate over a 10-year period of time, whatever it might be. You say, I don't care. That's unbelievable. So in a grand big picture, absolutely still a huge window of opportunity. Longer term rates have been backing up. It is an interesting topic. I would expect that would probably continue to happen. We probably continue to see some volatility. I think there's a little bit of push and pull between the Federal Reserve saying we're going to keep things low. It's pretty clear they're biased to throw the entire kitchen sink right at the economy, that there's been pretty direct comments of you can't overdo the stimulus at this point. And it's to their benefits. Can you say we will keep rates low? And I think the market is trying to test that. You get positive new COVID vaccine news coming out. You get more bond issuance coming. And I think the market's trying to question, will they really be able to keep rates as low for as long as they say? Certainly it will be low for probably the immediate future, but is it really going to persist as long as they would expect?
Yeah. Craig, along those lines, what have you been seeing on the taxable and tax exempt side of bonds and where costs of capital are getting locked in relative to the last couple of years?
Yeah, I think that's important, an important distinction between the taxable and the tax exempt market. I think last year investors found a lot of value in the tax exempt market relative to taxable instruments. The 10-year Treasury at one point was in the 50s and 60s, where a shorter tenor tax exempt muni was maybe in 70 and 80, and then you're getting the tax exempt benefit from that. I think historically, I agree with Ramon. When I got into this line of business about 15 years ago, the common knowledge was a 20-year run-of-the-mill mid-level credit, maybe an A-rated credit bond issue for a general government was probably going to yield in the 4.50 to 5% range over 20 years. And then after the financial crisis hit, that came down, and that's part market-based, right? There was a flight to quality. People started looking for a place to invest that they knew there was going to be safety in principle and some return. So in 2013, at that point, rates were roughly in the mid-twos for a 20-year bond issue. Just last year, we did a 20-year school bond issue that came in at about a 158. So that's a fixed rate over 20 years, which, I'm not the oldest guy out there, but I don't know if that's ever been seen before. And we'll see if we test that again. And then to Ramon's point, rates have risen. In late December, early January, the 10-year Treasury was right around 90 basis points. And as of yesterday, it was 154. So in a very short period of time, rates have risen a decent amount.
Great. Ramon, the Fed's indicated that it intends on maintaining its low for long policy while the economy continues to weather the effects of the pandemic. What does history tell us about some of the triggers the Fed will look to as it perhaps looks to adjust rates and bring them back up over time?
Historically, there's been two triggers they're really concerned about, the labor market and inflation. And historically, they tended to be proactive. So long as there was a strong labor market, they felt unemployment was trending in the right direction, and there's multiple indicators that there is a strong labor market. Once inflation started to get close to their target, they tended to, at that point, look to increase rates, which makes sense. I mean, the economy is a big ship to turn, right? So they tend to cut significantly going down. It's fairly rare that you tend to see really significant, hikes on the way up. They tend to be more measured, well forecasted. And so it makes sense that you think we start to slowly ratchet up before inflation hits. What's a little bit unique this time is the Fed seems to be much less concerned about inflation whatsoever, and pretty direct about that and blatant. They have expressed a much stronger concern for the labor market, and they've expressed multiple measures for that. So I think that they are much less concerned. Powell said, I believe it was last week, within the last week explicitly, labor market maximum strength across multiple measures, inflation at or above 2%. So they don't just want 2%. By the time they start moving at that point, it's running a little bit warm, if not hot. And thirdly, forecasters expect inflation to remain at that level or higher. So not just do we kind of tiptoe above that or get close to it, I think are really wanting inflation to catch a little bit. So we'll see if they're playing with fire or not in that respect. But I think it makes sense given what they went through the financial crisis. They are less concerned at this point, very clearly, with inflation. So those would be the three targets, though: labor market broadly, inflation above 2%, and then the market or economists generally predicting inflation will remain above 2%.
Very good. So before I ask this next question, as we were prepping for this, John reminded me of Warren Buffett's quote that any company that employs an economist has one employee too many. And I'm not sure as an economics major or someone that works for John how I exactly feel about that. But with that in mind, and the fact that there's still a tremendous amount of uncertainty that exists in the economy, as you guys sit here today, what are your expectations for where rates are headed in the next 12 months? And Ramon, let's start with you, and then we'll move to John and Craig.
Sure. So typically I like to kind of bifurcate between short-term rates and then the longer-term rates, because I do think it can be sometimes easy to mix those together. So short-term rates in the immediate near term, I think there's relatively low risk that those will increase by the Federal Reserve. I think it's fairly reasonable to expect for the next 6 to 18 months, those will remain where they are. From a longer-term perspective, I tend to fall in a similar camp, despite having worked in interest rate markets, my career, maybe because of that. It is incredibly difficult to forecast where longer-term rates go over any long period of time. I would say, though, I think it would be reasonable to expect continued volatility, particularly in the long end of the market. And part of that is, in general, markets tend to be much more volatile in a sell-off when prices are being sold than in a build-up. And the treasury market is opposite, right? You start, as you function through, you're going to see fluctuations in rates going up and down, inverted to that. And so you're going to see the treasury market have a little bit more volatility, particularly as this push and pull goes with the Fed. We're not moving rates. They're saying, can you really not move rates? And so I would anticipate more volatility in the long end of the yield curve. I think it would be surprising if that went away in the short term. I also, don't put much weight behind that, candidly. I think that I would defer to anybody else's opinion, primarily because it is so difficult to forecast in rate markets.
Yeah, I would say that coming from a guy who was ultra short the Treasury in 2009 when it was at 3%, clearly I have no idea what direction rates are going. But, I also think about there was a period between, I think, 1977 and 82, so 5-year period where rates went, 10-year Treasury went from 7% to 14%, right? So doubled. I mean, so the point being, I think, is I would agree with Ramon that while we've been in sort of this long-term gradual decline in overall long-term rates, it does just feel like we're poised for some volatility one way or another. Over how long remains to be seen.
Craig?
Yeah, I would echo John and Ramon. Again, our world's a little different in that it's more based on the market and less based on necessarily what the Fed would decide to do. So when there's a large supply of municipal bonds, then investors can kind of pick and choose and maybe sit on the sidelines a little more, which in itself will cause rates to go up in the municipal market and for issuers. The other thing that I think is interesting, when Ramon touched on the short end versus the long end, we've seen, because the demand for municipal bonds has been so high, we've seen investors maybe take more chances from a credit quality standpoint, which has compressed credit quality, just seeking yield. So the demand for more yield causing more people to buy maybe riskier credits has compressed riskier credit rates a little bit. And as things start to settle out a little bit, I think there's potential maybe for some of the riskier credit bonds or investments to shoot up a little quicker, just due to supply and demand. And as yields start to rise, there's going to be less people reaching for those riskier credit investments.
Great. Well, before we move into our last topic on interest rate risk mitigation, let's go ahead and pull up our third polling question for the audience. We just asked our panelists here where they thought rates were headed. Now it's your chance to prognosticate along with them. So where do you think rates will go in the next 12 months? Up, down, or no change? I think as you guys talked about a little bit, we've seen those longer term rates starting to creep up relatively quickly. The 10-year hit 150, I think, this week. And I just saw that this morning, Freddie Mac had released a survey that 30-year mortgages had broke 3% for the first time in a while. So I think, again, as we look at where short-term rates are at and continue to remain, suppressed, we're looking at the longer end of the curve rising and a steepening of this curve, which has just been somewhat counter to what we've experienced over the last few years. We, worked through an inverted yield curve prior to the pandemic, and then what's been just an extremely flat curve ever since it reverted. We'll wait for those results to come in. I think we may have lost Ramon. Looked like we had some connection issues there. So 81% of the audience thinks that rates are headed up, and 16% thinks they're going down, we'll stay flat, and no one thinks they're going down, which makes sense because we're already about as low as they can go. So let's move into our third topic, trying to manage interest rate risk. As we've talked about, rates are at historic lows, which, as our audience just indicated, there's only one way for them to generally go. John, what are some ways in which businesses traditionally hedge interest rate risk?
Yeah, I think the real question is what is your fixed to floating rate ratio, right? And what's sort of the best structure from your balance sheet and interest rate risk exposure standpoint? And I think that question is dependent on the nature of your business, right? And so what we tend to do or advise our customers is, really match the repayment of the debt or that interest rate risk, the life of that repayment, the ability for you to increase prices. If you're a distributor, you have some flexibility in increasing prices when inflation goes up. You got, short-term debt that's revolving, that makes sense to be floating. You can adjust, hopefully, your pricing relative to interest rates moving. If you're a real estate developer, obviously, with maybe fixed lease payments coming in, that you want to fix that debt and make sure that, you're almost, perfectly hedged or to the extent you can. So if you're, a highly leveraged business and you want to take some of the, repayment volatility out of your income statement, obviously makes sense to hedge a lot of that. So, I think it's very dependent on the nature of your business, your ability to raise rates, the amount of leverage that you have. And then also beyond that, most of our businesses tend to look like almost like a barbell strategy where you've got, about 50% of your debt in a revolving capacity that floats, and then the rest, on a 5 to 7 year. And so you're less exposed to sort of the middle part of the curve. Obviously, that creates some refinance risk when that debt comes up, but that's generally a good cycle to be on in a good structure to sort of carry on your balance sheet.
Yeah, and along those lines, Ramon, welcome back, first of all. And then second, maybe walk us through as we think about ways to hedge interest rate volatility. One of the most common ways is through a swap. Maybe walk the audience through, just in its simplest form, a plain vanilla swap.
Sure. So a good portion of my time is spent working, with borrowers. Oftentimes it might be the first swap they've done. So This is a high level. Usually we'd have a more extended conversation. But the general idea is a swap locks in or fixes the cost of a variable rate index. So traditionally that was Libor. Libor changes every month. I'll use that as the example, but you could use any replacement index. So 1 month Libor for a 5-year term, you have 60 different months during that 5-year term. And so 60 different chances for that index to set at a different rate. A swap contract just by itself is an agreement to swap fixed and floating cash flows. So you might agree to pay FNBO a fixed rate, and in return, they would pay you 1 month Libor every month. You might say, well, why would I want to do that? And the reason you would do that is if you pair that with a floating rate loan, those floating interest rates are going to cancel each other out. So if in a swap you receive a variable index like Libor, and you pay that same index on a loan, you've locked in that cost. Those are a pass through. So effectively, you can think of a swap rate is it's a longer term rate that you're locking in for that index. So there is no 5-year Libor rates. There is no 5-year prime rates. But the swap rate you're locking in is here is where the market could give you a fixed rate for that same term. And so a common question might come, well, why would I do that when I can just get a traditional fixed rate loan possibly? And generally, there's a couple reasons. One is a bank may be hesitant to go out for that long of a term with a traditional fixed rate loan. Candidly, the bank owns interest rate risk if it does that. Most banks fund themselves on a floating basis. So if the bank receives a fixed rate and short-term rates go up, the interest margin on that asset to the bank, the loan, it gets smaller and smaller, it can become negative. So banks like offering a floating rate loan and then offering a swap to the customers because it allows the bank to only protect its own margin a little more effectively. So you tend to get longer terms available. You tend to get better pricing because behind the scenes, banks use swaps themselves to manage their balance sheet. So rather than doing this on a portfolio basis, it tends to be done deal by deal. And so you get better pricing that way typically. And then the other option is the flexibility. So a traditional fixed rate loan, once you lock in that rate, you have fixed rate debt, that's it. An interest rate swap is very customizable. So you can express a particular rate outlook if you have one. For example, in the current rate environment, we work with many borrowers who say, I'm not worried about interest rates today. I'm worried about interest rates for the last 6 years of my 7-year deal. So that's fine. We could structure an interest rate swap that doesn't start for 1 year out. You float for the next year. And so you have a floating rate loan, it's independent, you've locked in the debt that you care about, and then you have a separate conversation, how do you want to manage that rate risk? And generally it's customized to match that. So high level, it fixes a variable rate loan, and it provides a lot of customized solution around that, and it tends to be attractive pricing and term that you can get with it at a high level.
Yeah. Craig, as John and Ramon, kind of talked about this alignment of assets and liabilities and, banks working with their customers, through that because there's two sides to the equation, so to speak, that asset liability mix has to work for both parties on the borrowing and the lending side. As you look at the public debt side of things, there's oftentimes a different funding base outside of banks that you're placing debt with, be it insurance companies, pension funds, folks that have a longer term investment horizon that you can then align those assets and liabilities with. What sort of structure are you seeing that market accept today versus what you've seen over the last few years?
Yeah, that's a good question. I think not unlike the conversation or the statement I made about maybe people reaching a little bit on the credit side to find more yield, the demand has allowed some investors or some issuers to seek more favorable terms and more flexibility. So low rates have kind of been a given for the last year, but the other kind of levers within a deal, whether it be prepayment flexibility, call provisions, the ability to not fund a debt service reserve fund, which has been a mainstay in revenue bonds forever. The market has kind of accepted that we don't need you to set aside that cash anymore. So I just think you've seen behavior on the investor side that has really benefited the issuer side. And then, it's going to be interesting as people stop to reach for yield as rates start to rise and the demand starts to go down a little bit, to see if some of those levers kind of come back in. If people start to demand more strict prepayment terms and more reserves set aside, stricter covenants in terms of debt service coverage ratio and some of those items.
Got it. And I know in the audience today, we've got a number of folks from, nonprofits, public agencies, municipalities, so to speak, that are potentially locked into fixed rate deals today on the bond side. For borrowers that locked in rates in a different rate environment, what are some things they should be thinking about in today's rate environment, and what options might exist for them for potentially doing advanced refundings or things of that nature?
Yeah, great question. So one real interesting, I think, thing that's come out of the market recently or over the last year is the compression of yields between the tax exempt market and the taxable market. That's allowed for a lot of opportunities to maybe do some non-traditional financings for either issuers or nonprofits that are traditionally used to borrowing on a tax exempt basis at that lower rate. So it's made sense. We've seen a lot of issuers refinancing what was originally tax exempt debt with now taxable debt, which just seems counterintuitive, but that again just lends to the market environment we've been in. I think it was 2017 during tax reform is when the elimination of and a tax exempt advanced refunding came about, which in the past, prior to that, one time throughout the life of an issue, issuers could execute a tax exempt advanced refunding and lock in that cost even prior to their call via escrow and defeasance. But again, recently, especially over the last year, the taxable rates have been low enough where a lot of issuers have executed taxable advanced refundings and seen a cost benefit to that, a savings in terms of interest. Now, as the administration changes, there's been a lot of discussion about this administration potentially bringing back tax exempt advanced refundings, which is a good thing for issuers and borrowers, and frankly taxpayers, because the whole genesis behind that is to save money. But that hasn't been a priority. There's some other things going on right now. But I do think that the discussion is starting to ramp up. I also think that the ability to maybe execute on a taxable advanced refunding is dwindling a little bit, primarily because of the main topic we've been talking about today. Interest rates are starting to rise, specifically in the taxable market. Taxable deals are often spread to that 10-year treasury. So 10-year treasury maybe as a base and then a credit spread to that. And as those rise, those taxable advanced refundings become less and less realistic and the savings start to go away.
Got it. Thanks, Craig. Well, let's move into our Q&A session with the audience. And just a reminder that as we're posing a few of these questions, feel free to send additional questions in via the chat function. So a couple questions around SOFR specifically. So John, I'll point this one to you first. And you alluded to this earlier, but when does FNBO anticipate potentially using SOFR for its customers?
That's a great question. I think that remains to be seen, but I would hope and suspect that we have something stood up and ready by the end of the year. I think operationally there's still some issues. Ramon he alluded to some of them, but one of the concepts is pegging the term SOFR to some sort of historical 5-year look back spread. So if it's 1 year or something like that, we look at SOFR to Libor and then peg that spread based on a 5-year look back. And so there are still some operational challenges around that and making sure that there aren't unintended consequences. So I think that right now the hope and plan is that we have something stood up by the end of the year. The market generally, the big banks will drive a lot of this too, right? I mean, they're the ones generally that are the agents on these big syndicated credits. Once they start to convert to SOFR, we will have to follow. Everything else, I think it makes more sense for borrowers, especially if you're not, needing to, swap or hedge, get into prime. It's much more stable. There's a, long track record, and it's, hey, exactly where the effective Fed funds rate is at all times. It's very clear, it's transparent. And prime is just effectively a spread to that. So in a long roundabout way, I didn't answer the question, Matt, but the point is we're working on it, and we're trying to, we're trying to stand it up.
Yeah, bankers are a little bit like politicians. We can say a lot without actually saying anything sometimes, right, John?
Yeah, exactly.
One thing I'll say
Ramon,
with that, I feel like you guys are well prepared for it. Derivative Path works with a large number of banks, over 130 across the nation. I have not spoken to one bank that has said, we're all ready for SOFR, let's start doing it. It is clients are uneasy with them. There is a dislocation. So I think you're spot on, John, that you'll have you guys are ahead of the curve as far as having, a plan in place for what we see, and your customers should take comfort in that. But I agree with you. Prime tends to be, unless you're a major global money center bank that's being told you have to use SOFR, I haven't seen anybody raise their hands and say, can we please start using it? So I think you guys are well in line and probably better off than many others that we work with.
Ramon, to that point, and there was another question kind of specific to the derivative side of things. You had touched on earlier just the number of, or the amount of derivative contracts, interest rate swaps maybe specifically, that are still tied to Libor. Maybe just speak specifically what the transition away from Libor on those swaps looks like, and the index that is expected to be used, whether it's SOFR or something else.
Sure. So if you do have an outstanding interest rate swap or derivative that references Libor, whether with FMBO or another bank, you will need to touch that contract similar to how the loan may have to be. So a lot of loans have fairly broad fallback language, existing if this index goes away, pick something else. The derivatives market is a bit more structured. And so at the top of the market, the very high level participants, dealers, the largest players in the market, they have adopted specific fallback language to use SOFR. And they have had to elect to choose to use that. So inter-dealer transactions all have a standard fallback to a very specific definition of how SOFR will be used for different terms. Most borrowers or corporate end users probably will not have seen that same type of adoption, and will probably need to work with their bank on how to use that. So the key there, if you do have a swap, is it's probably hedging a debt, it's a loan of some piece. And the key is you want to make sure that that loan and swap stay in sync. And so the piece you want to avoid is, well, I'll agree on my swap to go ahead and convert this to SOFR, but this bank XYZ is saying we'll change the loan to prime. Now you have a mismatch between your swap and the item you're hedging, and it creates risk for you. It can create accounting issues. So the intent is to keep those in line. One way to do that is to adopt the same fallback language. If the loan and swap both say, hey, if this goes away, we agree to replace it with this exact same rate, now you don't have to worry about it. The other way is to actively just change that transaction. I want to get rid of a Libor-based transaction, replace it with a prime-based transaction. And in that case, if you actively choose to do that, you no longer are subject to Libor going away because you don't have a Libor contract anyways. So those are the two most common ways we tend to see that being addressed. You will want to look at each deal individually. You'll want to work with your banker on that. But I will say that is a common transaction that we're doing, is to say, let's go from a Libor-based transaction to a prime-based transaction. Just we were talking earlier, it is much more common. If you are going SOFR, you just want to make sure that the definitions are aligned. It can be a bit technical, but it's something that can be overcome for sure.
All right, thanks, Ramon. And with that, we'll go ahead and kind of wrap things up for today's session. But again, want to thank our audience for tuning in today. I want to thank all of our panelists for joining us. FNBO Business Insights will be back later this spring and through the rest of 2021. covering a number of topics, everything from business succession planning to cybersecurity and fraud, even community investment and kind of corporate philanthropy. So we'll look forward to seeing everyone throughout 2021, and thanks again, and have a great weekend.
Thank you.
Thanks, Matt.